Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So there is a company that has been on my watch list for quite some time. This is a company that's in the semiconductor sector. It's been on my radar for quite some time. I like the semiconductors. They're very cyclical businesses, and I'll talk about that a bit later. But I genuinely like the company, and I have been watching it. Right now it seems it's basically a little bit mispriced. So what we're going to do today is talk about the company. So what does it actually do? That's the first question. The second question is, are basically the margins, and if is the company profitable? So we look at the margins, we look at the revenues, we look at things like profit margins, return on equity, return on invested capital. We look at the EPS or earnings per share, the free cash flow side of things, and then we will look at the valuation side of it to see if it's actually a buy right now. So if it's a great company, should we buy it right now, or should we wait it for a bit longer? Maybe it's basically overvalued and we might have to wait, and so on. So these are the type of questions you should always be asking, especially if you are new to investing. You really have to ask these questions yourself. What does the company do? Does it actually have a good financials? So for example, are they a profitable business? And then, is it a buy right now, or should I just wait a bit longer? Once you've answered all these questions, you can do whatever. So what I'm going to do is that I'm going to answer those questions, and then at the end I'm going to tell you exactly what I would be doing with this company moving forward, inshallah. So I don't own it yet, but I will tell you inshallah what I will be doing. If you haven't pressed that like button already, please do so. It really genuinely helps the channel, and join us in the journey, inshallah. Right, the company that we're going to talk about today is Lam Research Corporation. This company is in the semiconductor. Like I said, it specializes in front-end wafer processing, which involves creating the active components and wiring of semiconductor devices. So it works with a lot of the companies out there, and a very similar business to KLA. So I used to own KLA for quite a long time ago, sold it, made a little bit of money, but again since then it has gone up so much. So I'm looking at this currently thinking, okay, Qualcomm, basically when it comes to Quant, for example, is saying strong buy, Wall Street is saying it's a buy, Seeking Alpha is saying it's a buy as well. So all around buy. So what I'm going to do is I'm going to give you the little bit of information about the company, and then we'll take it from there. Now the first thing we're going to look at is basically the financials. So they've reported recently, so they beat both top line and bottom line beat, although that was very, very close, but it's still a bit nevertheless. Now with regards moving forward, I think they're guiding it really nicely. There's nothing to worry about with regards to what they're guiding. They're forecasting about over 5 billion when it comes to Q2 of this year, which includes the guidance also included gross margin of almost 50%, operating margin of 35%, 34% almost, and EPS of $1.20 plus or minus basically 10 cents. Okay. And looking to the future for this company when it comes to earnings expectations, if we look at, let's just first look at quarterly, and you will see what is going on with the business. As you can see here, we got about basically Q4 of this year, they're expecting about 47% year over year growth, which is absolutely amazing. And then Q1 of 2025 for them, September 2025, which is basically this year, is basically about 14%, then about 2% and so on. But on average, when we look at it annualized, okay, it's about 32% this year. So June of this year is when they report their final, I think, basically final Q. There we go. And after that, basically it's flat. Then basically the year after, we're looking at about 16%, then 11%, 14%. What that's EPS. Revenue side of it, about 22% this year, 23% for the following year, 10%, 11% the following year, and so on. So it is a very, very cyclical business, like I said at the beginning, and you really genuinely have to be careful, because if you're buying semiconductors today and thinking that the revenue is going to basically steadily grow every single year, it's not going to happen. There will be times where things are not basically, and that's when the market will actually drop this company. So maybe people will take the profit here, drop it here, and buy back here again. And that's basically, if you're doing day trading, of course that's fine, but if you're a long-term investor, you just need to have that long-term mentality. The company is about almost to 96 billion market. It has a 96 billion market cap. They do have a basically dividend of 1.2. looks reasonably valued right now. 66% safety, A-rated basically credit rating side of things, so low debt and so on. Payout ratios right now for that dividend is about 25%, 15% growth in the last, basically the latest, and the last 5 years they grew that about 13%, which is really nice. Last 10 years we're looking at about 46%. Basically they grew that basically 46%. Again, there's not a lot of companies out there that can do this sort of a thing. Okay, so they've been increasing this dividend for the last 10 years. You get just below $1 for every share of this company that you own. And if we look at basically the valuation side of it, if we just look at the last 5 years where it was, normally if we basically if this basically graph is inside that blue line, we're saying it's basically looks reasonably valued. If it's below that, okay, then it's undervalued. So it's hit undervaluation territory recently, but it's sort of a bouncing back right now as we speak. Now looking at the rest of the financials, you can see EPS has been growing over the last whatever years. So from basically less than about half a dollar to right now $4.13. It's heading the right direction. Shares outstanding, as you can see, is declining, which is nice to see, because that means every share of this company that you own is now worth more. If you bought it 10 years ago and basically this is how much they had, right now this is where we are. So this is actually better for you as a long-term investor. Total sales or revenue side of things, as you can see, we've got years where it's heading the right direction, and then a couple of years where it basically a year where it drops and then it bounces back, and then a massive jump there, another massive jump, a year where it's almost just gone up tiny bit, another drop in 2024, 2025, next 12 months they're expecting it to bounce back again. It might drop again. So it is very cyclical business, like I said. But look at this here. Return on equity, we're looking at about 53%, which is absolutely amazing. Return on invested capital of 30%, operating margin 31%, and free cash flow margin of 22%, and debt levels almost non-existent, which is really nice to see. So whenever you look basically, in terms of financials, in terms of these, margin matrix that we're looking at, it's actually absolutely amazing. There's nothing wrong with the business side of things. So what we now need to see is, okay, it's a great business. We can also look at a couple of things in the financials. If we go to revenue side of things, we've already seen the revenue, but let's see how much they're spending. Okay, from 5 billion to now 17, they spend about almost a 9 billion. So they've got gross profit about $8 billion, which is nice from that 17 that they've made. Of course, they spend a lot of money on research and development, which is basically expected from this type of business, okay? But the net income, we're looking at about $4.6 billion, which is really good. Now, EPS is more or less the same. We've already seen sort of from less than $1 to right now where we are, okay? And then if we check out the balance sheet, again, with debt levels and so on, we've already seen they have almost zero debt. So total assets, we're looking at about almost to $20 billion against total liabilities for this company about $10 billion. So they've got enough to cover everything they need to cover basically. Now if we look at the basically cash flow here, and we scroll down to where we're looking for we're looking for free cash flow here. Free cash flow over $2.8 billion, which is absolutely fine. Okay, that covers the dividends and everything else. So now you know what the company does. We've got some of the financials, the main bits. There's a lot more you can look at to basically go into these websites, look at the valuations of the last couple of years, look at the growth side of it. Okay, look at the profitability side of it. We've already said, like, we looked at the gross profit margins, we've seen the EBITDAs and so on. You can look at that, return on capital, return on basically total assets. There's loads of things that you can look at and then compare it with the 5-year, which is absolutely fine. The website I'm using here is a Seeking Alpha, so you can look at the growth of the business. Revenue, for example, basically over the last 5 years grew about 12%. Basically right now in the last 12 months, we're looking at about 20%, which is absolutely amazing, right? And then you can look at the growth of the EBITDA, you can look at free cash flow growth and so on. So there's a lot more information that you can look at this company. But what I'm really interested is this part here, the evaluation side of it. When you look at the PE based on, we're looking at non-GAAP, okay, 21 basically it's been over about 22 over the last 5 years, and right now it's about here. So that's why it seems a little bit cheap. But what we're going to do is we're going to use fast track for this, okay, and I'll tell you exactly what Morningstar is saying, but we're going to use this first. Now, how this works is the orange line is basically the earnings, and is also the fair value. Basically that sort of tells us if this line here, the price is higher, okay, then the orange line, then that means that basically the stock is expensive, because remember, the price should normally track the earnings of the business, because otherwise it wouldn't make sense, right? So each company, wherever it's trading right now, should be trading around where where it's heading, or where it's been over the last whatever years. So if you look at the since 2005, you can see, if we put the prices again in the line, so by the way, the blue line is what Mr. Market likes to value this company. So that's the normal PE the market trades, this stock trades, and then the orange line is basically the earnings. Okay, so if we add price here, and like I said, price should be normally, for undervaluation, price should be below the orange line. Now, if you bought this stock when it was, what PE was it? It was about 40 PE there, and you hold it up until that 34 PE, or basically, so if you had it since 2005 basically, and you invested $10,000 right now, you would have, okay, including dividends and everything else, $444,000 just for that one business. You would have made about 21% almost, okay, top an annualized rate of return, which is absolutely amazing. Now, of course, maybe we didn't buy it there. That was when it was about over, basically almost the world 40 PE we're looking at. No, sorry, we were looking at, what PE was it? 30 something, I think it was. Now, if you bought it when it was actually slightly lower, about 7 PE there, and you hold it up until where it was 35, you would have made 303,743. Okay, annualized, you would have made about 30, so you would have made more money. So hence, this is why I'm saying, when it comes to valuation, it's really important that you're buying these companies when they're undervalued and not when they're overvalued. So again, if you bought it, I think this, let's go to COVID. Let's go actually to COVID, because I want to see what the company was doing. Okay, so if you bought it beginning of COVID, as soon as the COVID happened, and you've sold it right now, you would have made almost a 51%. Okay, 51%, because remember the time from 2020 to right now 2025, so the last 5 years, you would have made your 10,000 would have been closer to almost a 50, let's call it 58,000 basically. Okay, and that's why it's important to buy this company when they're undervalued. However, let's say you did the opposite, and you bought it basically when you had a PE of 29, and you've sold it right now. You would have lost about 32% every single year for your 10,000. Okay, 10,000 investment. It's not the long period of time. It's basically, remember, this is 2023 to right now 2025. So within 2 years, you would have lost about $3,000 of your 10,000 investment. So it is important to look at valuations and really buy these companies when they seem undervalued. And right now is below that orange line. It's in between basically the orange line, which is about 20 fair value right now. And we're looking at operating. So the company is basically earnings is about 21 right now. Okay, basically that whole period of time. If we just check last 10 years, okay, you expecting the earnings was about 16. Fair value was about 16, and the normal PE was about 17. Again, it's not too expensive. If we look at, for example, the last 5 years, you can see about 7% earnings growth. Fair value was about 15, which is normal PE that we normally looking for, and the normal PE of 22. Okay, now what we want to do is, now we've seen when the company has been, and if where we should have, at what time it was, the best time to buy this company and so on. And what we want to know now is basically where the company is heading. So basically, if we click the last 5 years, the dotted lines here are basically what's going to happen next couple of years. So 2025, 2026, 2027. So if you look at 2025, that we're expecting about that 32%. We've already seen that when it comes to EPS. 2026 is a negative 20. So you can see that line there kind of drops there. Okay. And then 2027, we're expecting about 16% growth. And if that happens, okay, where will the company be? And we're just going to use the estimates basing, okay? So we've got 8, let's call it 9% when it comes to the earnings growth expectations. And then fair value basically about 15. Right now, if you bought this stock right now for this price, okay, you would have actually lost about 2%. Now, if we use the normal PE, okay, which is basically this 18 line, you would be making about 9%. Okay, 9%, or you would be in your 10,000 investment will be 12 over just 12,000 US dollars, including dividends and so on. Now let's just basically compare this company moving forward. So valuation, it doesn't look like it's too expensive right now, so it looks like maybe a slight drop in the next couple of months or whatever, then potentially we will be just basically break even, or if we use the normal PE, you'll be making about that 9% and so on. So that's the risk that you need to take if you are thinking this company is undervalued and so on. In terms of performance over the last whatever years, okay, against the S&P 500, if I just click the last 10 years, I'm just going to focus on the last 10 years against the S&P 500. If you invested 10,000 on this company, you would right now would have closer to 53,000 US dollars against that 23,000 for the S&P 500. Look at the returns. The returns are 24 for this one, and then basically 12 for the S&P 500. So I actually beat the S&P 500 massively, which is nice to see. And again, despite the company having any earnings that are not basically straight line, because some years it's some years basically is up, some years is down. As you can see, the orange line going up and down, very cyclical business, you're still making at least 28% for that period of time. So it is important to remember all of these things that we just talked about. And of course, it had the fact that it has a very low debt, paying you dividends of basically 1.3, earnings expectation. So the EPS yield, for example, right now is about 5%. Normally we're looking about 6-7% or so on, or higher, if you know what I mean. So yeah, it looks really great. Company is in a good position right now, maybe fairly valued, okay. But if we look at Morningstar valuation for this company, you can see it's a 4-star stock right now, and it has a wide moat of WIP, okay, and it basically they expected the price to be $86 per share. Right now is $75 per share. So the next question is, what am I doing with this company? I actually bought it. I actually added to the family portfolio. I don't normally share the family portfolio here, but you can go to the if you basically join us to the Patreon account, you'll have access to it. I will be updating them basically next couple of days too, because I've made some changes. And as you can see here, I bought 10 shares and my average is right now $71 per share. I'm up a little bit, which is quite nice. So I'm just going to hold on to this one and add to it every single week, month, whenever I get a chance. So as you can see, I bought those 10 shares. The cost of market value right now is $751 US. So there you have it. That's the company that I wanted to share with you guys today. I hope you're enjoying this type of content, because it takes a lot of time and effort to put these videos together. I would genuinely appreciate it if you can like it, the video, subscribe, hit to the channel, share with your family and friends, and at the same time join us here. If you can join us at the Patreon account, it genuinely helps the channel. Of course, there's a lot of subscription and things I pay for, so hopefully I can cover that cost from here. So yeah, that would be absolutely amazing. Have a wonderful day. Assalamu Alaikum.